And we do have CPI that's due tomorrow. That inflation number is very important. The Fed guessing game continues all around it, as that report could dim the outlook for future cuts. For more on this, we want to bring in former Kansas City Fed President Thomas Hoenig. He's now a distinguished senior fellow with George Mason University's Mercatus Center. And thank you for being with us today, Tom. Let's first get your thoughts on what you think that inflation read is going to be, because there's a lot riding on it.
Well, it's hard to know, but I mean, people are projecting that inflation will stay near the CPI near the 3% number. Whether it comes down or not is a big question mark. No one knows. I don't. But I do think there's a lot of reasons to expect it's going to remain elevated. And if you start with the real economy, as we've already been talking about, the economy is doing relatively well. We just saw the jobs number. We saw the manufacturing index numbers strong, greater than 50%. And we're also seeing the commodity markets pick up. Not only in the United States are we seeing this improvement, which has been our track record, but around the world. So that means there's a lot of demand being, I think, created in this stronger economy. And then on the financial side of this, you have basically the banking industry is being backstopped in terms of the liquidity issues around the Fed. The Fed still has a lot of liquidity out there. Its excess reserves are still above $3.5 trillion. It's still working with the money markets and has $0.5 trillion there. So there's just a lot of liquidity still available in the market, and I think that's also a factor stimulating. So it's going to be, I think, real questionable whether the Fed can lower interest rates as it wishes. We'll see what tomorrow's CPI number goes. But one final point I'd make on this, that right now the Fed so-called Fed funds rate is near 5.5%, and a lot of people, including myself, think that the so-called real equilibrium interest rate is around 2%. If you think about that, and you think of inflation, your Fed funds rate is 5.5. Take 3% out of that, you're 2.25% real rates. You're really not a particularly tight monetary policy right now. So I think there's a lot of reasons for the Fed to think carefully about that next move, influenced importantly by the inflation numbers that come out, but also just about how well the economy in the U.S. and now picking up globally is. So they have a big challenge ahead of them. And I'm not sure that interest rate cuts necessarily should be on the table, but we'll see.
It's really weird. I mean, Neil Kashkari, who I've always thought of as being pretty dovish, is saying that he doesn't anticipate any cuts this year. And then you have former St. Louis Fed President Bullard, who's saying he still thinks it's 3 cuts for this year. I mean, how do you come out with such a diverse outcome of opinions and people kind of flipping the roles of what you would have traditionally expected, because Bullard's always been pretty hawkish?
Well, that's a very good question. I don't know what Bullard's thinking is, and I am surprised by Neil, but I think Neil's comments make a little more sense, given how strong the economy is and how much liquidity is in the U.S. economy and globally, for that matter. So maybe Jim is thinking that, well, we are going to see a slowdown. We are going to see inflation numbers. They've come down. Maybe they're going to continue. But I think about it as when you think of where interest rates are and where they should be, they're not that far off the mark, so long as the banking industry doesn't run into difficulty. And I think the Fed is determined to make sure liquidity problems don't enter the banking industry, which gives you, I think, a good case to leave things where they are. And that's what Neil is advocating, it appears.
I will say Bullard did predicate it with the same thing that you just said. That's on the assumption that inflation does continue on a downward trajectory. I guess, how confident are you in the data that we're getting? We're saying we're so data dependent right now, but 1 month's data can be pretty useless, or kind of something that gets revised away later. If you're looking at 3 months, though, where inflation runs hotter than expected, where jobs run hotter than expected, does that make you think there's no way a rate cut should come if that number this week is hotter than expected?
Well, I think right now, even without looking at those numbers coming forward, if you look at the conditions in the U.S. economy and globally, there's no real case for cutting rates. We're near equilibrium. You wouldn't want to cut them very much if you cut them at all. because the fact is real interest rates are a little more than 2%. And that's probably where they belong, given how strong the world economy is and how strong the U.S. economy is. So, yes, we'll look at the data. You're data dependent. But in the long term, in terms of this, I think where we are is probably a pretty good place, watching the banking industry carefully and making sure we know where our liquidity is and that the liquidity that the Fed's continuing to supply. And if that remains strong, I think it would be hard to justify a rate cut.